Hi, good afternoon. This is Matt Sainholtz with Tobias Financial Advisors. We are about to begin our second quarter 2017 economic and market update webinar. We are just going to hold on for just like 1 or 2 more minutes until we have a few more attendees signed on, and then we'll begin. I'll be back shortly. Thank you. Good afternoon. This is Matt Sainholtz again from Tobias Financial Advisors. Thanks for joining us today as we review the second quarter and year-to-date as far as the financial markets and economic progress that's been taking place throughout the world. So thanks for joining us today. I'll be joined with Ben Tobias and Marinella Collado.
Good afternoon, all.
Hello. Good afternoon.
And so we will be following some presentation slides here. There should be a way when you're looking at the webinar screen here to type in questions to us as they come up. If you'd like to use that feature, please do so, and we'll try to address the questions towards the end. Tobias Financial Advisors, as you know, is a registered investment advisor with the SEC. We are today giving kind of general guidance, general information about how the markets performed and some economic themes that we might be experiencing in the overall broad economy. This is not a substitute for individualized portfolio advice. Anything that we say shouldn't be taken as unique to your circumstances. Please visit with one of our investment advisor representatives to discuss your particular portfolio and your particular unique situation.
And that's a great point, Matt. We'll just talk about general themes here. And again, if you have questions as to how these points relate to your portfolio, we can discuss that in more detail.
Great. So today's agenda, which we'll be going through, will be the economic and investment environment, a bit of market summary, and then kind of review the world stock performance, U.S. stock performance, international fixed income, and some general ideas that we're seeing across the economy and markets. So just first on the kind of some high-level economic data as far as the U.S. growth. The United States economy is still chugging along. It's kind of the same story that's been for the past few years, where we're running at about 1 to 2% GDP growth, and that has, you know, everyone wishes it would be more, but at the same time, we're not in a recession. So we kind of keep chugging along. We have some of the economic numbers coming in related to the low unemployment figures. Also, inflation's a little bit lower than what the Fed would like to see as far as their targeted inflation. And so that's why we'll get to kind of the fixed income. We'll discuss what they've been doing with interest rates in the past few months.
So I think we've probably seen just more momentum on the pro-business regulation, which we hope will be one of the things that will boost our economy. And then also just if we see some movement in the way of tax reform, that will also be something that could contribute to more economic growth. So I think the general theme in the U.S. side is slow and stable expansion.
As far as earnings, corporate, what are the major companies in the U.S. doing so far? Of course, we're not going to dive into company-specific earnings, but in general, earnings are positive. Earnings are continuing to grow amongst U.S. major corporations. As far as monetary policy, this is what I was describing with what the Fed is doing. They've raised interest rates this past June, and they've forecasted, actually there's a meeting today, they're finishing up a meeting today by the Fed to determine if they're going to raise interest rates again. General consensus is that they will not be raising interest rates today, but might set the stage for further rate increases or decreasing the Federal Reserve's balance sheet as we go into the fall and winter of 2017.
So I think it's fair to say that we can expect to see continued yet gradual increases in the short-term rates.
Mm-hmm. International markets, we'll kind of go through those in some future slides, but actually international markets have outperformed U.S. stock markets so far this year in 2017. Generally speaking, their economies have been, they're still getting, at least in the Eurozone, they're still having accommodative monetary policy where we've seen our Fed start to pump the brakes. Traditionally, when interest rates rise, it's kind of putting a little bit of a lag on the overall economy as far as, but when you look over across the pond in Europe, they're still being very accommodative in their monetary policy.
And so here, global growth has rebounded, and we expect to see this trend for the balance of 2017. And I think it's fair to say this has pretty much been our view for the past few years, is to just have an overweight or a significant allocation to international.
Mm-hmm.
Do you want to add anything to that?
No, it's been very consistent with the international, and the expectation is when you look at what's happened over the last few years, the domestic markets before the recent past have outperformed international for a good bit of time. And the way things are going right now, expectation is really gaining momentum that the international markets should be exceeding the domestic markets.
And specifically, I guess, on the emerging market side, which is where we've seen the most growth. And speaking of that.
Yep. Speaking of emerging markets returns, so these arrows here indicate some broad asset classes and their performance in the second quarter of 2017. So going across left to right on the screen you're looking at, the U.S. stock market did a 3% return in the second quarter, whereas international developed, this is Europe, Japan, those major types of countries, have done 5.6%, whereas emerging markets has done 6%. So what we've kind of just discussed, you can see in the data that the markets have returned positively for the second quarter. We've also have listed here since 2001 some best quarters and worst quarters, and these are just kind of interesting to note. They're almost kind of outliers. They're almost kind of off the charts as far as what we've seen in back in 2008 and 2009 during the Great Financial Crisis. We saw some major quarterly swings, and we'll touch a little bit more about volatility and how the lack thereof of volatility in the markets that we've seen over the past couple of years in some upcoming slides. So overall, stock markets have done well, even in the face of some headlines that maybe not have been so well, which is, kind of one of our philosophies too, is not necessarily to overreact to any sort of one piece of news information. You can read these different types of news event. One news event was actually the U.S. oil market has been taking a hit and is then now into a bear market territory, which is defined by having a 20% drop, and that's mostly due to supply worries and overproduction of oil. Also, alternative resources for energy has also played into some of the pricing of the oil market. But even as the oil market has tumbled, you can kind of see that stocks have continued held up and continued to grow in the second quarter. And so these are, that's just kind of our overall philosophy, is that we want to keep our clients invested in a well-diversified portfolio and maybe not overreact to any one particular piece of news or information, and keep that kind of structured portfolio guidance in place.
Yeah, and I love this chart because, you know, it has all the headlines and what the market did, and at the end of the day, you know, you just can't trade on those headlines.
That media loves the headlines and make you believe what's happening in Washington on a day-to-day basis, what is happening elsewhere on a day-to-day basis, really has a great effect on the economy. And the truth of the matter is, it doesn't.
Yeah, right. We'll try to stay away from the political speaking as best we can, but
Sorry.
it's very true. It's very true. If you watch some of the domestic news networks, you could really kind of get yourself worked up about what's happening in Washington. But as you can see, the markets have progressed on. So this chart
is a perfect segue. I think this is a perfect segue into sort of, you know, what the result is of one particular moment in time causing a reaction in the market versus what the year ends up looking like. So I think what's interesting here is so far for 2017, the market has been down as much as -3%. And if you see, it actually, at year to date, it's up 8%. So I think this is a perfect chart that illustrates sort of what could happen during the year and then how differently the market will end at the end of the year. I don't know if you want to talk about
Right, yeah. So just a little bit of background on this slide. It's measuring, going back to 1980, the average return of the S&P 500, which is broad U.S. companies, large U.S. companies. So what this is showing is the gray line is the actual year performance, the calendar year performance. And then the red line is the red number is the drawdown, the biggest drawdown of that year. And so for the past many years, we haven't had experienced anything greater than a -20% drawdown. And by definition, that means that we haven't had a bear market in 8 or 9 years, because a 20% drop is the definition of a bear market. So we haven't seen that much volatility. And so, you know, we always want to remind ourselves that the markets don't always go up. There is going to be volatility, and as you can see, having the -3, the last time we only had a -3 drawdown, we were actually up 34%, and that was back, it looks like, about 1995.
So we're hoping that does repeat. I mean,
that would be great. But you know, this is kind of just that information where you look at and remember that the market has been kind of quiet. We've experienced some great returns over the past few years, but the volatility hasn't been there. And we expect at some point, we can't exactly know when, but volatility will return to the market, and that's when we'll do some of our rebalancing techniques in our portfolios.
So just to get a little bit more granular on U.S. stocks, we've seen many U.S. companies post positive returns for the quarter, but overall it's underperformed in the non-U.S. and emerging markets. And the theme has been that large value stocks have underperformed growth stocks. And I don't know if we want to talk a little bit about our tilt towards value, which has historically been the bluest of the blue chip, and we've tended to have a tilt towards value. Just historically, just believing in the return of those stocks.
And when you really think of it, value does a couple of things that growth doesn't. One is value, I traditionally more view dividend-paying stocks. So you have that income coming in. And that also has the effect of when you have large market swings, generally growth stocks, which have lower dividends, will swing higher and lower faster than value.
Mm-hmm.
So the value gives a little more stability to the portfolio and is generally a little bit more conservative than the growth.
One thing I'd like to point out on this chart is the bottom left, that pie chart. This is kind of interesting to see as we go through the slides, that of the world market capitalization of publicly traded companies, the United States accounts for 52% of the world stock market valuation. And so you'll see how international and emerging markets compare to that number as we move forward. But when you think about, when someone says we got to own the market as a portfolio, the U.S. portion for equity, if you just went by market cap, is about 52% of the entire investable universe as far as equities are concerned. So just want to point that out, that you know, when we diversify globally, we have an opportunity to reach markets across the world, of course, and have a different return and not be so home country biased. But if we go to the next slide, we kind of see that international makes up 36%. Again, this is the Eurozone, Japan, Australia, developed kind of G4 type of countries, major countries out there in the investment world. And so what has happened in international space is that, again, we've seen that the growth companies have outpaced some of the value companies so far this year. But when you translate that back into U.S. dollars, the U.S. dollar actually has become a bit weaker this year, which helps our international exposure.
And this is, the U.S. dollar, it's an interesting phenomenon, I guess you could call it. Obviously, the world is not on a single currency for the entire world. It would make investing a lot easier if that were the case. However, what we have is, you know, you could have an investment in England, for example, and that investment might go up by 10%, but at the same time, there might be a 10% change in the value between the pound and the dollar. So for our purposes, conceivably, you will see zero change in the value of that investment. So the dollar needs, you know, the value of the dollar, when the dollar's going up, it hurts the way our international allocation looks. When the value of the dollar goes down, it helps. More recently, it's been going down, but it has a long way to go because it is higher right now than normal.
So now this is talking about emerging markets.
Yeah, talking about emerging markets, just to kind of continue the theme, I'll just point out that 11% of the world's capitalization is in emerging markets. So for a lot of our client portfolios, there is an emerging market component of the international sector that we invest in. These companies, these countries are generally, they're mostly, the headliners would be like Brazil, China, India. These are countries that have a less established economic systems, legal systems, but still, nonetheless, still major players in the world economy. So these types of allocations are traditionally higher risk, higher reward, more volatility. And so that we keep a measured portion in most people's client portfolios.
Right, and that's a good point you raised, because they're not seeing emerging markets as an asset class by itself. So it's something that we slice and dice within the non-U.S. portion of your portfolio.
Right, and this is, again, one of the highest as far as asset classes in the second quarter. This is one as far as equity. This is one of the highest earning asset classes. These countries are, you know, set up. That's why they're called emerging. They could, and we can't pick exactly all the winners and all the losers to really pinpoint if, you know, Brazil's going to do better than China or whatnot. But these countries have one advantage potentially over some of the domestic countries, and that's where the debt comes into play. Some of the European countries a couple of years ago, there's a lot of debt. A lot of Greece is the one that always comes up, but there's a lot of debt involved and a lot of leverage in some of these European economies. Some of these emerging markets haven't had that much debt issuance yet, so they're still their balance sheets look a little bit better sometimes than developed countries.
That's what I was going to add, that they're showing strengthening balance sheets pretty much across the emerging markets.
So bonds, fixed income. This is where the Fed has raised rates in the past quarter. So just quickly, it's kind of the inverse. When the Federal Reserve raises rates, or the market just pushes interest rates up, the value of a bond, or potentially a bond fund, reacts the other way, where it goes down in value. And so, nonetheless, the shorter term rates, which are the 1-year to 5-year duration type of fixed income instruments, have seen an increase in the interest rates, so a little bit less in performance, whereas the longer term bonds, 30-year bonds, are seeing, they've actually experienced a little bit of interest rate decrease, which has increased the performance of longer term bonds. Right now, currently, we generally target more of the shorter end of the yield curve, meaning the time, whether it's 1 year or 30 years where we tend to invest. We generally are focusing on more of the shorter end of the yield curve, the shorter term maturity bonds and bond funds, because rates have been historically low across the globe. And at some point, and we've already started seeing this in the United States, rates are going to hopefully naturally move up with either the help of central banks around the world or with the just economic pressures of pushing rates up.
And this is one of our favorite charts. It's a little ugly when you look at it. It's our quilt chart. It just kind of lays out the performance of each asset class on a by year. And I think this is one of the things that solidifies our investment philosophy, in that, you know, it's going to be hard to pick which asset class we should overweight in, or trying to do any asset class selection, because they're going to be all over the place. So our safe bet is to ride a smooth wave and have a diversified portfolio. And you'll see that's the gray box, or that black line is tracing. For 2016, a diversified portfolio had a return of about 8.3%. And year to date, we're looking at a 6.8% on a diversified portfolio. And for this particular model, I think they're at the 60-40 allocation in terms of determining that yield. So that's really, we like to use this as a sort of a reference, kind of compare our portfolio performance to what they're determining to be the yield or the return of a diversified portfolio on a yearly basis.
Right. And J.P. Morgan, just so everyone's aware, J.P. Morgan develops this chart and kind of comes up with a broad-based asset allocation that this chart is based upon. So, you know, it is a pretty balanced portfolio. Year to date, as you can see, again, emerging market equity on this chart, we've been talking about second quarter returns. Through June 30th, emerging markets have been up over 18%. And you slide that down to the other end of the spectrum, commodities and cash have, well, cash hasn't, due to the low interest rate environment, hasn't performed well, but commodities is the one asset class that's negative so far year to date. As of June 30th. And
I'd like to point out, if we could just look at the emerging markets for 2015, where they were down 14%. We had a few clients, because one of the things we do, and I'm sure we've talked about this at every meeting, is being strategic about which assets, what assets we place in the taxable accounts versus non-taxable or tax-deferred accounts. And we tend to put the emerging markets in the tax-deferred or tax-free accounts, generally your Roth IRAs or traditional IRAs. And, you know, sometimes it's a tendency to just say, well, my Roth IRA isn't performing as well as the other accounts. And that's because we look at this as one whole pie. And I remember going back a couple of years where clients were saying, don't put me anymore in emerging markets, just, you know, decrease my allocation. And look at that. I mean, this is why you can't make that decision just based on 1 year, because things move around from year to year, and now it's the top of the performing chart.
Mm-hmm. So just kind of wrap up with some general themes that we're tracking and seeing in the portfolios and just a general economic environment. So like one of the major questions that we typically get asked and kind of think about is, what is going on in Washington and how is that going to affect our portfolios? So, one of the major campaign promises was one idea that was floated was more infrastructure spending and lower tax rates. That has yet to find its way through to the president's desk to sign off upon. So, how things as far as actual effects on the economy, lowering tax rates, that might be something that could potentially be a headwind if no deal gets done as we move forward. But it's a wait and see. We're not going to make a major change into the portfolios. But just as to answer like what could be on the horizon that could bring this market back would be one thing might be capital spending or the lack of a tax rate change policy.
And really on the corporate side, which would, again, boost the economy because there's going to free up a lot of cash for investing and maybe even potentially encourage companies to come back to the U.S. because that's why a lot of them have actually established headquarters outside of the U.S. to avoid the U.S. taxation.
And that's important. And really the most important part about the changes to the tax laws is that they happen in that right now we're in a period of uncertainty. Markets do not like uncertainty, and whatever happens will be good for the markets because people will be able to plan then. Businesses will be able to plan, know what's going to happen. There are too many questions going on right now as to tax policy, and that has a negative effect.
So we're going to continue to kind of focus on the international markets and making sure we have an allocation abroad for some of the various reasons that we have outlined in today's presentation. So we're going to continue with our mantra and our philosophy of a globally diversified portfolio. And on the bond side, it looks like interest rates, at least domestically, the Fed has indicated there may be at least one more interest rate increase this year, and they're also thinking about they have a lot of bonds sitting on their balance sheet, and letting those roll off of their balance sheet would act again as a kind of a potential for interest rates to increase. So we're going to try to target bond funds that hold towards the shorter end of the maturity spectrum, and that pretty much kind of concludes our presentation today. The kind of idea behind this is to just kind of give easy access to our clients and our portfolio, the people that we work with, give them a little bit of background. We hope to do this on a quarterly basis going forward. We also hope to have another webinar later on this year, perhaps more about just our investment philosophy and about what rebalancing means in the portfolio and how we kind of set the strategy going forward.
So we hope you found this informative and helpful, and if you have any questions, you can feel free to post the question online or call us if you'd like.
Yeah, so thanks for joining us today.
Thank you.
Thank you.
And we'll appreciate any feedback you could give us. Thank you.
Take care. Bye-bye.